So let me welcome you to the last session of the day. The topic is financial sector reform, and the speaker is Charles Goodhart, Emeritus Professor and member, Financial Markets Group, London School of Economics. And the discussant is Jeremy Rudin, Assistant Deputy Minister, Financial Sector, Policy Branch, Department of Finance. I'll just hand it over to you.
Thank you very much indeed. Apart from the great pleasure of seeing Chuck again and my many Canadian friends, it's a particular pleasure to be talking in Tory House in the week that the Conservatives regain power. I have to say that I walked round Tory House twice trying to find the Lib Dem annex. But unfortunately, I've failed to find it. I hope to have this pointed out to me shortly. I also have to say that there's bound to be a degree of overlap between the previous session and this session, because the adoption of a new set of macroprudential instruments is such a key part of both reforming the financial structure and indeed of making it less pro-cyclical, that it's quite difficult not to cover some of the same ground. But the field is so immense, there are so many facets to it, that I think that you will find that there's quite a lot of ground which will differ between the previous session and this session. Now, I would start by saying that banking and finance are inherently and inevitably pro-cyclical. During the upturn, borrower defaults, non-performing loans go down, volatility goes down, risk appears to be less, margins that are required are less. Inevitably, with risk appearing to be less, leverage increases, and you get an expansion of banking, finance, asset prices, all in the upturn, and then it goes in the opposite direction in the downturn. And I think this is both inevitable, there's nothing irrational about it, it's simply bound to happen. The problem, or one of the problems has been that I think that this pro-cyclicality, inherent pro-cyclicality, has actually been made somewhat worse by a number of policy decisions that have been made over the last sort of 10 years or so. Not intentionally, it was an unintended side product. And whether or not it's been made worse by policy measures is a question of how much we can do to try and mitigate this. And indeed, much of the previous session dealt with macroprudential measures that were intended to do just that. And as I say, I'm bound to cover a certain amount of the same ground. And then I'd like to end up with a sort of comment or two about what may happen. Now, some of the measures that enhance pro-cyclicality, the change in the capital adequacy requirements in Basel II. One of the problems of Basel I, of course, was that the credit risk requirements were very, very broad brush. And indeed, there was a single credit risk rating for all lending to the private sector, whether this was to the very best company in the country or to a fly-by-night, whatever you might think, small company. And clearly that led to a tendency for banks to securitize those loans which were to companies where the required capital was higher than it should be, and keep on their balance sheets those loans to companies where the requirements were actually lower. So the initial securitization were the best loans, leaving the banks to hold the worst loans on their books. And so Basel I had the misfortune that it actually led banks almost to become bad banks, in which they held the worst quality loans and securitized the best quality loans. And the idea that was followed, and it was a very understandable idea, was that what you should do is that you should relate the requirement, the capital requirement, to the relative riskiness of the loan. And it makes sort of obvious sense. The problem with that was that the relative riskiness of a loan depends, particularly if you do point-in-time rating, and it's very difficult to do through the cycle rating because nobody knows exactly where the hell you are in the cycle. And for a variety of reasons, point-in-time rating is always much more likely to be undertaken, whether within a rating agency or within the internal ratings of the banks themselves. And that meant that inevitably what you got was that it appeared that the ratings appeared to improve and risk appeared to decline during the upturn, and vice versa during the downturn. Whereas everybody knows that if you do this statistically, as for example the Spanish have done in their studies of dynamic pre-provisioning, that it's during the upturn, when you're undertaking masses of loans, that actually you get your really bad debts developing. And during the downturn, where you're being much more cautious, that actually the proportion of defaults declines. So that the risk ratings effectively are inversely related to the true riskiness of the activities of the banks. Moreover, of course, that whole approach is exacerbated by the increasing shift from a sort of hold to maturity to a mark-to-market type approach, which meant that every time the asset price went up, this flowed straight through to the P&L and to the capital. And this effectively led to a development whereby the regulators themselves misread the situation, as did the markets. If you look at the CDS numbers for banks were at their minimum CDS spreads in July 2007. Moreover, most of the regulators, when they were faced with the initial subprime, effectively said to themselves, this cannot be a problem because the banks have never been more profitable. The banks have never been better capitalized than they were in the summer of 2007. And of course, if you do everything on a mark-to-market basis, particularly, and you abide by these cyclical ratings, that's almost inevitable. In fact, of course, given the leverage that had been involved and the effect that would occur with a turnaround in asset prices, the banks were in a very potentially risky situation. They weren't that massively strong. And the banks realized effectively before the regulators that there was a potential solvency problem, and that was the reason why they wouldn't actually lend to each other. But they pulled the wool, I think, over the regulators' eyes in saying it was just a liquidity problem. And it took far too long for the regulators and the authorities to appreciate that behind this liquidity problem was, and inevitably was, a solvency problem. Let me turn to the next point, which is the liquidity issue. There's a very interesting paper by Schulerich and Taylor, which shows that over the period up to about 1939, credit expansion, particularly bank credit expansion, and bank deposits rose more or less sort of pari passu, one for one. But increasingly from about the 1960s onward, for reasons that I don't think we fully understand yet, what happened was that bank credit expansion rose at a significantly faster rate than ordinary bank deposits, retail bank deposits. Now, the way that the banks dealt with this was threefold. First, particularly because the Basel Committee found it impossible to, although they tried, to establish a liquidity accord to accompany the capital accord, the banks ran down their holdings of liquid public sector debt from, in the UK, being about 30 to 40% of their total assets in the early 1960s, to of the order of, at one stage it was actually minus. Now, how can you hold minus public sector debt? Very easily. Effectively, you borrow more than you actually hold on your books. And so that the banks as a group completely eliminated their holding of liquid assets. One of the reasons that they did this was a substitution of funding assets or funding liquidity, whereby you borrowed from the wholesale markets. And here the idea was that if the banks were sufficiently well capitalized, and Basel II was supposed to justify that, a bank could always borrow on funding through the wholesale markets. And unfortunately, those rather comfortable assumptions broke apart in July 2007, with the August 2007, with the effective result that with so much of this funding, wholesale funding being very short term, that the liquidity problem vastly complemented and went with the solvency problem. Then we got the problem of remuneration, if you like, governance. And here, again, there have been a number of really quite serious trends. One of the problems was that the large broker-dealers in the US were all, or virtually all, partnerships, until I can't remember when. Don would be able to remind me, sometime in the 80s and quite recently. Now, if it's a partnership, it's effectively your own money you're playing with, and if anything goes wrong, it's your own money that gets you into, you lose your own money. And with a partnership, it actually is perfectly appropriate that you have massive great bonuses, because you can face massive great losses if things go badly wrong. The problem was that the kind of bonus structure and remuneration structure that were developed effectively during the partnership stage fed over to and continued through to the stage in which they all shifted onto a limited liability. Now, beyond that, there was a tendency to use a phrase for governance, which was, in hindsight, hideously misguided, as Bebchuk and others have indicated. And here the phrase is, what you need to do is to align the interests of the executives with those of the shareholders. Now, the reason why this was hideously misguided is because the shareholders are, of course, limited liability. And that means that any set of properly diversified shareholders will be egging on the executives to taking on as much risk as they can, because effectively a shareholder is in a position of somebody holding a call option, and if the mean expected return is the same, the greater the variance, the better off you are. And that means that shareholders are always tending to push the executives, particularly during good times, to take on maximum risk. Northern Rock was the darling of the London Stock Exchange until about 4 months before it collapsed. And there are, I think, very strong reasons for believing that what we need to do is to prevent the executives having the same incentive structure as the shareholders. In other words, we want to put on much more downside. Sorry, where we got to? Let me go back. Then beyond that, Basel II and the whole system was manipulated. Not only light touch regulation, But there was a problem of a splendid degree of regulatory arbitrage between the US banks and the European banks. The European banks had no leverage ratio, but they did have Basel II. The US banks had a leverage ratio under fiducia, but they did not have Basel II. Now, that meant that what you wanted, if you were a European bank, was you wanted an asset that appeared to be safe but gave you a reasonably high return. And that meant that when all these CDOs were developed, the AAA tranches were very largely shipped over to UBS and similar European banks, who, because they didn't have a leverage ratio requirement, the leverage ratio of more European banks of admirable names, whose leverage ratio were over 50 to 1, at which under fiducia they were strictly undercapitalized and should have been shut unless they could be recapitalized. Some of the names of the banks that are over 50 to 1 are not just Northern Rock or UBS, but I think I probably better not say some of these other names. Well, the American banks, who had no significant Basel II, but they did have a leverage ratio, of course, took the riskier end of the CDOs. So there was sort of a splendid arbitrage between the two, and even within the US. Because one of the reasons why the crisis occurred was that the SEC applied Basel II, but no leverage ratio, to the broker-dealers, whose leverage ratio shot up over the last few years. Then let me go on quickly to housing and the government support of housing. You all know the sad story of Fannie Mae and Freddie Mac, and I don't need to go over it, but what I do need to go over is that the normal practice of competition in the normal form of asset price cycle means that during the upturn, the loan-to-value ratios go way up. Northern Rock was doing a loan-to-value ratio at one stage in its splendidly entitled Together mortgage approach of 125%. 125%. And 95 to 100% was quite common. Now, of course, in the downturn, the loan-to-value ratios that you can get are sort of 75 to 80%. Now, that vastly exaggerates the housing cycle, because when the loan-to-value ratio goes down from 100 to 75, it effectively means that all the first-time buyers who had been expecting to get on the housing ladder without putting down a cent now get rationed out of it, and rationed out of it for maybe 2 years. And it was very largely, I think, the Canadian approach to a much more sensible way of managing your housing market than was true in either the US or the UK or Spain or Ireland or any of the others that helped to spare you from the worst aspects of all of this. Let me end this bit with moral hazard. What we, I think, have done is we've moved inevitably from the Bagehot principle, and the Bagehot principle effectively was that if the collateral is good and if the institution is solvent, you lend to it, otherwise you don't let it go, effectively to an insurance principle. And the insurance principle is that if you are too important, too interconnected, and too big to be a shut, then one way or another we will save you. And that, of course, leads to a great deal more moral hazard. It doesn't necessarily lead to taxpayer finance, because we could have kept these institutions open without requiring the taxpayer by putting a penalty on the, effectively, on the bond, subordinated bond creditor. Now, we chose not to do it. We chose not to do it. I think we chose not to do it for two reasons. One is that if we'd gone the other route, it would, I think, have involved a degree of temporary public ownership, which would have been described as nationalization, which politically was a no-no word. The other reason why we, I think, chose not to go down that route, and of hurting the bondholder rather than the taxpayer, was that so many of the banks were undercapitalized that we felt that if we attacked and penalized the bondholder, then nobody else would buy bonds that were being issued by any other bank. And we wanted banks to issue bonds, and if we were going to have banks issuing bonds, we actually had to guarantee the bondholders on the existing banks. So what sort of countermeasures can we have? Well, the first set of countermeasures are a couple which are characterized by a snappy and entirely misleading soundbite, both of them. The entirely snappy but entirely misleading soundbite on size is, if it's too big to fail, it is too big. Now, there are an awful lot of things that are too big to close or too big simply to liquidate. There are a lot of those which are quite small. When you get to a crisis, Northern Rock wasn't all that big. And the reason why it was too big, why it was, if you like, protected, was not that it was big, but that it was similar. If Northern Rock had been let go, Cheltenham and Gloucester and Bradford and Bingley would have had a run the next day, and HBOS, Halifax Bank of Scotland, would have had a run the day after that. And after Halifax and Bank of Scotland had had a run, there would have been a run in every single British bank. The idea that its size alone is simply not entirely true. It's partly interconnectedness. You can't, for example, let clearinghouses go. But it's also very largely similarities. BCCI was actually quite a large bank. Now, you could let it go because it wasn't interconnected, and there was no other bank, thank God, like it. And you can allow a Barings to go, not because Barings isn't large. Barings was allowed to go because it was subject to a fraudulent attack, and fraudulent attacks are idiosyncratic one-off. If you have a systemic event is likely to affect loads and loads and loads of rather similar institutions, many of them small. And this can develop into a domino development very rapidly. Remember 1929, 1933. And that was a period when lots and lots of small American banks went under, many of them country banks, where the big banks in Canada and the UK did not. It's not size, it's contagion very frequently through similarity that's the issue. Now let me move on to the next one, which is activity. And here, the misleading soundbite is we must separate the casino from the utility. Never has there been a financial intermediary less like a utility than Lehman's. It had no retail deposits. It had virtually no connection with the check payment system. You could describe, I think, Bear Stearns and Lehman's very largely, if you wanted to, as casinos under this sort of line of argument. And yet, allowing Lehman's to go under undoubtedly generated the panic. Equally, Northern Rock was very largely involved in straightforward, simple mortgage lending in the UK. It was undertaking far too risky a business, but in bread and butter exercise. Moreover, the idea that you should take a set of banks and effectively insist that they hold only completely safe assets means that your banks then are unable to do intermediation, and the whole rationale of the banking sector, I think, largely disappears. Remuneration. Now, this really is a tricky issue. One of the suggestions has been to try and make the executive's remuneration less like the shareholders, so that there is more downside. It's not just a flat salary and then a bonus. And one of the suggestions that has been made, for example, is to make the bonuses net of tax of senior executives in banks unlimited liability, in the sense that if the bank goes down, that those who received bonuses from those banks over a limited number of period of years should be required to pay all the bonuses net of tax that they've received. Then, of course, there are the various approaches towards insurance and various forms of self-insurance. One of these is the contingent capital. Now, contingent capital is one of the great fashions of the moment, and you need to be a bit wary of it. Incidentally, there was something very like contingent capital in the double liability of equity shareholders, which was used in Northern America, both in the US and in Canada. And before one goes too far into the contingent capital, you better consider very deeply why the double liability to equity shareholders did not work. Now, the contingent capital approach, this kicks in a situation where the bank is in difficulties and there is a potential shortfall or loss to be met. One of the questions is who's going to meet the shortfall when the contingent capital, when that is triggered. Let's ignore the issue about how the triggers are set. Either the bondholder of the COCO, the contingent convertible capital, or the shareholder is going to have to suffer quite a large loss. If it's going to be the bondholder, the contingent capital, then what you're going to find is that as the banks run into difficulty, the bondholder of the COCOs is going to hedge themselves by shorting their own equity. And whenever a COCO gets triggered and the bondholder suffers a loss, then what's going to happen is that all the other holders of COCOs on other banks are going to short their equity in order to hedge their position, and they're all going to be triggered more or less instantaneously. Now, one of the things that you can't do if the bondholder is going to suffer a loss is to allow these bonds to be held by any other financial intermediary. Otherwise, you've got a straight AIG problem. And what's more, what you're going to find is there's going to be a huge, effectively, implosion of value, of loss, under the circumstances when they're all triggered instantaneously. Now, faced with that kind of situation, the proposers of COCOs have moved towards the other approach, which is to say, let's not impose a penalty when it's triggered on the bondholder. Let's impose a penalty on the shareholder by giving the bondholders of COCOs so much of the equity that the equity holders are effectively diluted out of it. And to some extent, that is the purpose of the exercise, to try and get the equity holders to raise more equity before they get diluted to death. If you're going to do that, you've got to have a fairly high trigger, which makes effectively the equity holders raise more equity while the going is still good. And that's quite expensive. And that means that anyone, if these COCO systems get involved, anyone who wants to hold a bank equity is going to realize that the probability of massive dilution is going to be quite high. And under those circumstances, with the probability of massive dilution being quite high, the equity holder will require a much higher return than previously. The market details of what the relative costs of issuing COCOs under different forms of loss application might be have simply not been done. It's a fashionable idea which has not been properly analyzed and not been properly studied. I'm going to skip public sector insurance because I'm probably going too slowly and move on to countercyclical capital adequacy requirements and countercyclical liquidity and all the rest of it. And Philip has gone through a lot of it. The one point that I want to stress here is the question of whether this countercyclicality is going to be done by rules or discretion. And here I would point out that there's a massive difference between the views of academics and the views of central bankers. Virtually all central bankers say that countercyclicality is a great idea, but we want to do it by discretion, because no rule will ever work properly. The problem is that central banks have been able to do countercyclical discretionary adjustment of these regulations for a very long time. Pillar 2 of Basel II, which enabled European banks to do this, indeed any other country that was using Basel II, Pillar 2 always allowed central banks to apply countercyclical discretion. Did they use it? As far as I know, the use of Pillar 2 was effectively zero. One of the problems here is that if you're going to do Pillar 2, you are running against the market. You're always running against the market if you're doing countercyclical, almost by definition. I take what is now regarded as a sort of demonized, how did they ever do it? Subprime mortgages. If ever there was an occasion when people should have done some countercyclical measures, surely it was to stop the subprime mortgages, 2005 to 2006. Now that was a period when subprime mortgages were regarded as one of the great innovations of financial engineering. The politicians loved them. The borrowers loved them. They might not now, but effectively, on these teaser rates, if you assumed that housing prices were going up, you got into the house you got onto the housing ladder at a cost that wasn't significantly higher than just renting, and you had a chance at getting onto the ladder and getting ownership with increasing equity. So borrowers inevitably loved it. The lenders loved it because they were making lots of money. You get up and you say, I think there's a bubble. I remember in the UK, the president of the Royal Economic Society, a member of the Monetary Policy Committee, Steve Nicol, coming to give a lecture at the British Academy, in which he said there's no housing bubble. Real interest rates are so low, particularly real long-term interest rates, that housing prices are entirely appropriate. I think that was 2000, it's either 2005, 2006. Whatever prices are, remember people, the efficient market hypothesis? Prices are where they are because half the people think they're going up. So in the idea that a central bank governor on his own is going to stand up and say, I think this is unsustainable, when half the population, including a lot of eminent economists, are going to say, of course it's sustainable, you're crazy, you're nutty. And the politicians like it, and the lenders are doing well, borrowers are doing well. It takes an enormous amount of guts to do this. Now, if every central banker was Paul Volcker, we could run a countercyclical discretionary policy. But they aren't. They're not Paul Volcker. If you're going to get a countercyclical policy, you have got to have something that really stiffens the backbones of central bankers. And the only way to do that is to have a degree of ex-ante rules. Some combination, for example, of excessive bank lending combined with excessive increases in housing prices. Now, we all know that rules aren't frequently inappropriate to changing conditions, but the great, I think, approach is comply or explain. At least have an ex-ante approach whereby a central banker will raise requirements when things start to expand, unless they are prepared to come out in public and explain why they don't. Poor old Alan Greenspan's reputation is not in great shape at the moment, but I think what would have happened if Alan Greenspan had had to testify in Congress to say the rules require me to raise various requirements in the housing market and on mortgages, but I am going to tell you why I think that's wrong. and then what happened should happen. Having to explain why you're not going to go along with these rules is, I think, a very, very strong approach. Now, let me move on to my final slide, and I'd like to go to the bottom because I haven't got all that much time. The point I want to make now is that any fool, and that means all of us, each of us, any of us, could make the banking system a lot safer. It's not difficult. Just raise required capital requirements, say from 4 to 15, increase liquidity, required liquidity ratios from nothing to 10%, introduce leverage ratios so that no institution shall be levered more than, say, 12 times, maybe add in a Peruvian bank tax as well. Yeah, I can make banks as safe as whatever. So why don't we? Why don't we? Why don't we make our banks completely safe? It really is, it's dirt easy to make banks safe, and it's simple. So why don't we do it? I think the reason why we don't do it is because of these measures will actually introduce quite serious additional costs compared to where they are at the moment on banking. We're going to raise significant additional costs on banking. The only way that the banks can recoup their position is effectively to raise the spread between deposits and bank lending. That effectively increases the cost of intermediation. And that, of course, will push an enormous amount of business across the border from the regulated banking sector into unregulated banks or unregulated intermediaries and unregulated markets within the country, and maybe to countries, to banks in less regulated countries. It's the old border problem. And under these circumstances, what we have to actually ask is not how do we make banks safe. What we ought to be asking is how safe do we want our banks to be? What actually do we want our banks to do? And we're not doing that. And we're just beginning to get into the issue about what will be the effect on spreads, what will be the effect on the size of the banking system, and what will be the effect on the rate of growth of bank credit of introducing all these measures. And these are the kind of questions that haven't been asked sufficiently. For example, in the Basel III proposals that have been sort of circulated with their introductory December, together with the taxes that are being suggested. Now, will they raise the spread between deposit and loan rates by 50 basis points? By 1%? By 5%? We haven't really done the work yet. And until you actually ask that kind of question and get the answer to that kind of question, you won't be able to tailor your measures to make banks safer to achieve the optimal outcome that you want between maintaining the role of banks and their intermediation process, the provision of bank credit, and at the same time the degree of additional safety which you want to have. We've got to be out at 5, and I think most of the rest of the points that I wanted to make there are fairly obvious. And I don't want to get into the question of who should do what. The home host business and the resolving cross-border institutions of the systemically important financial intermediaries, for example, the 19 who were subject to the US stress test, Again, Don will know a lot better than me, but I would guess that at least 17 of those 19, if not more, were cross-border institutions, had significant cross-border operations. And the real difficulty of the living will and the special resolution regime and resolving a bank, in other words, getting it in, or a systemically important financial intermediary, getting it into a state where it can be liquidated is the cross-border issue. And, for example, the amount of attention that is being paid in either the Dodd or the Barney-Frank bill to these cross-border issues is really very small. That's where the really tricky issues are occurring, and is where we are doing least. The real problem with Lehman's was not what happened to Lehman's New York, which were actually fairly well handled, but when Lehman's was allowed to go, and the reason it was such a disaster was that when Lehman's New York was handled all right, Lehman's London was just dropped. And the chaos that occurred on the Monday morning when the liquidator went into Lehman's London can hardly be described. And the effect of that was not good. So that is an area where we need to pay a great deal more attention. And what can happen on that, nobody knows. And here the difficulty is that it's all ultimately based on different legal traditions and different legal mechanisms. And until we can get some kind of harmonization of basic legal methods of doing special resolution regimes, living wills and liquidations, we're a long, long way from being able to handle systemic risk. Thank you.
What I wanted to ask you, I agreed with almost everything you said, and also Mr. Rudin, but I want to put forward one nuance. I agree with you about the procyclicality, especially on the commercial side, because banks I'm just using Canada, I'm not going to talk about Europe or the United States, because banks in Canada do not do term lending. They only do operating lines of credit, which by definition are priced off prime, prime plus 1, prime plus 2. So as the economy goes up, interest rates tighten, up they go, and down they go, and the economy's in a decline. And when you're doing your credit evaluations, which are done on a regular basis in the bank, you can't jump into a time machine and go forward 2 years and say, what's this company looking like 2 years from now when I don't know what the economy is like, and I don't know what that sector is doing, I don't know how exports are doing, innovation, and on and on and on. So I just don't see how you can get around that problem. Now let's move to the housing side. I do believe that the housing side, you can develop countercyclical policies. Mr. Rudin mentioned it, and yes, it can be difficult, although Mr. Flaherty just did it. I criticized him very publicly, saying I still think we should go back to 10% down payment. From throughout the 1950s, 60s, 70s, 80s, and 90s in this country, it was a 10% minimum cash down payment to get a high ratio mortgage, and that was only changed in the late 1990s. And secondly, just to show you the due diligence that was going on, and then I can bring that back to the pro-cyclicality, anti-cyclicality, the banks in those days demanded, you had to prove you had the cash, that you didn't go and borrow it on a downstroke down payment basis from a finance company. You had to come in with evidence that you had the cash. And the only time you could, quote, borrow it was if it was your mother or father, and we called that love capital. But otherwise, you couldn't borrow it. So you had to have the money, and there was no fiddling around. And the delinquency, I was running a $250 million mortgage portfolio, and I don't think we ever charged off one single dollar. So you can develop counter-cyclicality in housing by announcing well in advance, you know, we're going to go to a 10% or a 15% down payment or whatever, whereas I don't think you can do that on the commercial side because of the nature of operating lines of credit and the way you do due diligence on the commercial side. I mean, on the mortgage side, of course, it's typically fixed. You book the deal for 25 or 30 years, and you put it on the books, and away you go. You don't come back and renew it, or review it, I should say, every 2 years or once a year and that sort of thing. So that's really what I wanted to put forward to you, was the idea or the suggestion. And then the second, this is the collateral part, I'm just mystified, because you said you were surprised at people being surprised at the subprime. I was one of those people you're mystified about. I have never understood why the Americans did not demand a minimum 5 or 10% down. I do not know how any mortgage manager anywhere on the planet Earth would do a mortgage with 0 down payment. To me, it is apocalyptic.
Remember, the Northern Rock did exactly the same. And the problem is that when the markets are going very well, housing prices are going up, and people think that housing prices will go up further, and particularly when there's a lot of competition for market share, then you will get the mortgage lenders, when they're not constrained by regulation, putting up higher and higher loan-to-value ratios. And some of the loan-to-value ratios in the UK were as bad as anything that was done on subprime. We had our own subprime in the UK.
Go ahead.
Hi, Kim McPhail. My question is to Professor Goodhart and to what you closed with, which, as I recall, was to say that we are really not going to get a handle on addressing systemic risk without dealing with the cross-border issues and the different legal requirements and so on. And so, I mean, I could imagine that would be a very challenging prospect. So my question to you is, if that's kind of a first best scenario, what do you think the second best scenario is? And what do you think the kind of cost of that is relative to the first best scenario? And secondly, do you see the possibility of unintended, I think the word you used was byproducts of that kind of first best scenario?
I'm going to trespass onto rather dangerous ground, which is that the two countries that have come out best in this recent period of crisis in terms of their banking systems have been Australia and Canada. In both cases, they, to an outsider like me, seem to have taken measures to have reduced the extent of competition coming from banks, foreign banks. And in both cases, there was a degree to which the domestic banking system was subject to a degree of cartelized, almost inevitable profitability, so that the pressures to achieve market share, the pressures to maintain profits by going down the risk curve were, I think, less in Australia and Canada than they were elsewhere. One of the things that is very different now than it was in 1929, 1933, was that the people who were involved in the 1929-1933 crisis came to the conclusion that what had caused a lot of the damage was excessive competition. And most of the measures that were undertaken subsequently, like Glass-Steagall and all the rest of them, were actually aimed to reduce competition. Now, I think that a global financial system in which there is competition, but which there is a great degree of efficient, well-designed regulation, but competition and free competition everywhere is probably the first best. But if you can't get that, then maybe limiting the degree of competition in your own domestic market for a country that is in a position to do so, like yourselves, may be the second best.
I would just, if I may. So I can understand why Professor Goodhart and others often remark, and it's by no means unique to Professor Goodhart, that the situation in Canada must result from an attempt to protect domestic banks from foreign competition. What we have is a very liberal foreign bank entry regime, which has been progressively liberalized over an extended period of time. What we also have, which is not common in other countries, is a rule that requires banks of sufficient size to be widely held, so not to have a dominant owner. That is the same for the nationality of the owners are irrelevant. So a large Canadian bank could have more foreign owners than Canadian owners as long as they were widely distributed and didn't have a dominant shareholder. So I just wanted to open that, or close that parenthesis, I guess.
So perhaps we could go to
Mary Sekovich, I really appreciated your last comment because, in fact, if you look at on rates of return as an example of, in Canada, clearly we have a highly despite what you were saying there, that we do have a very highly concentrated banking sector. Which tends to give, on average, something like double what you get in the, in the industrial sector in terms of returns. And in that regard, I mean, it doesn't square so well that the competition is so strong here. But I mean, it was perhaps a good thing because it saved it from a worse catastrophe here, in that regard. And that might be a good thing. Now, I just wanted to ask you something, actually, because I really appreciated, I thoroughly appreciated your presentation, and I really have very little disagreement. But there's one issue that I was perhaps interested in your comments on, which has to do with the issue of the liquidity ratios of banks. You were basically at one point commenting on that. I haven't seen your paper, but in your comment you said that there was a downward share of public, government securities, and you couldn't quite explain why, perhaps. Okay? At least that's what you said now. I don't know if I quoted you right there. It seems to me, however, that one explanation would be on the supply side of those securities, and it would connect with the actual discussion we had this morning in terms of fiscal policy. That is to say that in a normal, if you think of it in terms of ups and downs of the business cycle, if you have a government sector that runs deficits in periods of recession and runs surpluses in periods of prosperity, you're going to basically be increasing in periods of recession the amount of government securities available, but in periods of prosperity will be the opposite. And in fact, in the case of Canada, probably the most extreme version here, because we had been running a string of budget surpluses for a dozen years. Now, if that would tend to restrict the amount or increase the scarcity of those government securities in these markets, that might in itself be an explanation. And I'm just wondering if this is not something that perhaps might explain some of that. Okay?
If one was really cynical, and I hope I'm not, one might go as far as to suggest it's not entirely accidental that the desire to get banks to hold a larger proportion of public sector debt should come at the same moment that the fiscal position of governments is getting a lot worse.
Okay, it seems there are no more questions. I'd like to thank Charles Goodhart and Jeremy Rudin